Good, now we can start. So today we will talk about the valuation of the common stocks. Last time we discussed how to value the bonds, and now we proceed to slightly more difficult type of the security, but still this is the basic one, and those are bonds and stock are probably the two most important securities in terms of the spreading and in terms of the importance for the real economy. The topics that we will cover today are presented on the slides. So first we will go through the multiple terminology associated with it. The trading of stocks, this whole procedure of trading, of the system of stocks trading is more complicated than the system of trading the bonds because the price changes faster and there are multiple other constituencies associated with its trading, and we will discuss it more in detail. So the technicality itself of the stocks trading. Then we will talk to you about the valuation of the stocks. The principle would be the similar as the one we used for the bonds, and frankly speaking, this is the main system we use almost everywhere for valuation in the finance. It is a valuation based on the expectations about the future cash flow that this asset would generate. And valuation of the stocks is not exception here. Also, we will think about how to model the cash flows that stocks would generate and estimate their present value in order to say how much the stock should cost at the moment of the estimation. Then we will go deeper to discuss the factors that would associate the stock's valuation. And you might remember from the first class that we mentioned that the crucial factor of determining the valuation of the firm and valuation of the stocks, which is basically the same, are the growth expectation about the firm, how fast we expect the firm to grow, not how fast the firm actually grows, but mostly expectations about the future growth of the firm. And we have a logical and mathematical techniques in order to estimate the growth of the firm, and we will apply it in order to estimate the stock price. First, we would estimate the growth of the firm, then we would estimate, using this growth, we'll estimate the stock price. And this same logic, as we talk about the stock, which is instrument that reflects the ownership rights to the firm, we will discuss how to estimate the whole business using the discounted cash flow model. So the logic would be similar, but technicality is slightly different. This is the plan for today's class. First of all, we will talk what the common stock is. The common stock is the ownership right to the publicly traded firm. There are multiple exchanges. Here I mentioned some of them: New York Stock Exchange, NASDAQ, European Exchange, Japanese, Shanghai, and 2 exchanges in Russia. Nowadays in Russia, we have an opportunity to purchase internationally traded stocks using St. Petersburg Exchange. Recently, Moscow Exchange also started to offer that, but so far the majority of international stocks are presented in the exchange in our city, in St. Petersburg. And Moscow Exchange is their main focus is the Russian traded companies, the main so-called blue chips and smaller firms as well. You can purchase the stocks of them through the Moscow Exchange. These days, we do not need to communicate with those exchanges directly. We do it with our brokerage firms. So installing some brokerage application on your smartphone or from your laptop, you can do the transaction, purchasing and selling the stocks in attempt to earn some money there. And apart from the common stocks, there is also kind of stocks, it's called the preferred stocks. We'll discuss them more in detail later in our course, but the main difference that preferred stocks receive the dividends earlier. They are senior in the sequences of receiving the dividends, and if the firm has not enough money to pay the dividends, the preferred stocks shareholders would receive dividends anyway, when the common stocks owners might not get them. But in return, the preferred stocks owners usually limited in the ownership rights over the firm. But the majority of the stocks are issued in the form of the common stocks, and we will mostly work with them. And in general, the terms and the logic that we'll walk you through today is applicable both for common stocks and for preferred stocks. Here we also have two other terms, primary market and the secondary market. The primary market is the market to sell the new securities by the corporations, the issuing of new stocks. When the firm does it first time, is called the initial public offering, IPO. But firm can have multiple rounds of offering its stocks to the market, and subsequent offers of the stocks would be called the initial public offering, second public offering, and so on. And all of those instances, then the firm itself offers the stocks for sale, then firm itself does it. It's called the primary market, regardless of whether it is the first time they do it or second time. The importance is it's the first time they offer this set of stocks for sale. For example, initial public offering might be just 5% of the ownership, but then firm expanded and decided to offer more stocks for sale. So then stocks goes from firm itself to the general audience, to any other investors. It is called the primary market. But of course, the almost entire stock market is consistent of the secondary market, when the stocks are traded among investors on the stock exchange. So once they are offered for sales, then they are constantly traded there, and that is why you always can buy or sell stocks of the market. And when you do it, you will almost always do it on the secondary market, apart from the times when you apply for IPO, but those are rare cases. So most of the trading is done here on the secondary market. The other terms which are relevant here would be the book value of the stock. There is the market value and the book value. The book value is something you should encounter from your accounting courses. This is the value of the firm based on its balance sheet. As you might expect, this value is quite a stable one, because it is once it's published, so all investors would work with this value, and this information is usually updated 4 times a year. In a quarterly reporting, firm would publish its balance sheet. Out of that you can see the book value of this firm. But the market value of the firm is something that changes way more frequently. We also call it market capitalization rate or market cap of the firm. It is the value of the firm which is calculated based on the market price of the firm. When the firm offers its stocks for exchange, for trading, then in other words, we say the firm goes public. After that, every second of trading or less than second, the firm would have the new market price. The market price of the firm would be estimated as the number of stocks multiplied on their current market price. And when the firm has market price, when the firm is public, it provides to it way more opportunity for financing, as apart from other things. The firm would have its market price estimation constantly, unlike closely held firms that would have only book value of the firm. And cash flows that investors would receive on the dividends are called, or excuse me, on the stocks are called dividends. Unlike bonds, the dividends are not obligatory for the firm. The firm can pay them or can omit them. The firm doesn't have to pay the dividends, and they usually do it when they have excessive cash flows, or if they did it earlier. So when we talk about the dividends for the firm, it is important not to reduce them, because reducing the dividends would mean the signal that the firm is doing worse. And dividends have important signaling characteristics, and the signals, the main signals in terms of the dividends, are their changes over time. So once firm paid some dividends, it's better not to reduce them. And another consequences of this fact, so that investors are keen on the dividends dynamic, is another consequence would be that the firms doesn't like to raise the dividend, because once they raise them, it would be bad if they would need to make them lower again. Occasionally, if there are some special occasion in the firm business, in the firm's operation, for example, when the firm sells some branch or some units, so the firm would have additional cash flows, and if shareholders decide that firm shouldn't invest it somewhere within its business, then shareholders would receive those money as a dividend. So when we talked about the bonds, the estimation of the cash flows were quite straightforward, as all, by the way, so maybe you would remind us, we call, so dividends are the cash flows for stocks, but how we call such cash flows for bonds? What is its name?
Coupons?
Coupon, yes. Well done. Thank you very much. So unlike dividends, coupons are fixed. They are mentioned in the prospect of issuing the bonds, and they're always the same. The dividends are mostly different. And as a result, there are more uncertainty regarding the future value of the stocks. And that is why the tools to estimate their price are more sophisticated. There are a lot of different approaches to estimate the stock price, to predict it, because if you have a working technique to predict the stock price, you might benefit from it. If you see that the price is higher than it should be, then you would go short, so in attempt to make the money on the reduction of the stock price. Or if you see that the stocks are undervalued, you might invest in these stocks and have the superior return in the future. But the problem is how to say whether the stock is underrated or overvalued. So in other words, how to estimate its fair price. Today we will go through the basic theory here that any other approach would be based on. But this is a good starting point for your investment career or for your investment ambitions to think on other approaches in order to estimate the stock price in order to become a successful investor. This is the screenshots from I took the left part from Yahoo Finance website, and the right part is taken from the terminal. From the terminal of some brokerage firm. This is the information on the Tesla firm. There were I did first screenshot here, then I did this screenshot, and as this stock is traded very actively, those 1 minute interval between those two screenshots, there is already difference in price here, and here. But this is about the same stock anyway. Let's go by the characteristics which I mentioned here, and those are characteristics that considered important for the basic analysis of the stock. For sure, there are multiple other characteristics, but so far let's discuss this one. What we have definitions for many of them at the subsequent page. So here we have this number is the current price of the stock. Maybe you can guess or you know. So if you would go to the let's say Yahoo Finance website, you will see that the price of the stock constantly changes. It changes very fast, particularly when the stock is liquid, like Tesla Motors. But there are many other liquid stocks where prices changes very, very frequently. What it means when the price changes? What should happen in order to have the new price for the stock? Do you have guesses here? What do you think?
May I guess?
Please.
Well, the number of people who are willing to sell their shares and the ones who are willing to buy, and they set a request changes over time in every second. And also in the second picture, you can see that that the demand and supply changes. The demand and the willingness to sell them changes. So I guess that's the reason.
Yeah, no, the all things you mentioned are correct, but I didn't hear the answer to the question. So what should happen to have the new price?
A sell should have happened.
Yes.
So stock must be sold.
Yeah, but so combining you guys' answers, both of you, we have the right answer if we combine it together. So there is a constant set of offering, so bids and ask prices. So ask price is the price at which you are ready to sell the stock, how much you ask in order to sell the stock, and bid price, how much you offer in order to purchase the stocks. And every time those two sets of orders meet with each other, overlap, we have the new price. And when they do overlap, it means that transactions happened. And this is how it works. So every time we see the change in price, it means that there were some transactions. And this is, in other words, we can say that this is the price of the last transaction. And as there are huge trading volume, the transactions can be done every millisecond, so multiple times per second. So that is why the price would change also quite frequently. Previous close price, it is the price at which the last transaction on the previous day were settled. So the exchanges have the trading days from the morning to the evening, and once the latest transaction is made, the stock exchange closes, and this transaction would be recorded as the close price. I see the question. Yeah, please, Amirar Salan. Yeah. Please go ahead.
That's me. Well, when we are setting a request to sell a stock, it gives us the offer to set it as the highest price, and the vice versa when we are trying to buy. So my question is, why we don't have like two prices, one for buying and one for selling, just like we have for the currency, for example, exchange market? Stupid question maybe, but
no, it's a fine question, but actually if you would go to the exchange, there is also the same market for the currency. Just having two prices are due to the broadening of the market, because we need to buy currency for our normal transactions when we go abroad, or when we at the firm make the trading with abroad. And as these requests are so frequent, the banks decided that they would settle the price daily, and in order to earn something there, they would have a spread between price at which they would purchase the stocks, or excuse me, currency, and price at which they would sell it. But if you would go to the website, the same Yahoo Finance, and type their euro currency or some other currency, you will see the same picture there. Just this, the availability of the two prices for the currency are due to the necessity to fix this price for some time for conducting some business operation, because we don't need to do this for the stocks, but sometimes we would need to do it for some other commodities like oil and others. But in essence, the trading process of currency and of the stocks would be similar. There is also this order book, there is bid, ask price, and once they are overlapping, we have the new exchange rate.
Thank you.
Yeah, and this is, by the way, if you have a brokerage account, you also have an opportunity to purchase the currency at the better rate than directly in the bank, because bank set them daily, but there you won't have this huge gap, and you can use it in order to change the currency. But I just thought that the problem might be just to withdraw it out of the account, but that depends on the conditions of your account, whether you are allowed to withdraw money from the brokerage account in the foreign currency. So there might be problems here, but anyway, you might have a better, most of the time you would have better exchange rate on the market than you have the bank. So here we have, let's go further by the line. There is close price of the previous day, so the last price yesterday or in the previous trading days, because during the weekend the exchanges are closed. Open price, it is today's price of the first transaction. And you see that the gap between the previous close price and the open price might be quite a significant one. And this is there are multiple reasons for that. First of all, there is additional information that emerges during the period when the exchange is closed, and that is why this information would be already incorporated in the very first transaction that would be settled here. And also, there is the main market. So for Tesla, it is Nasdaq stock exchange, but there is so-called pre-market trading in other markets, like in Russia. We have an opportunity to trade those stocks even during the periods then there is no trading on the main stock exchange using our local exchanges. And this information about the prices on other local exchanges also would be incorporated here, and the first transaction would be made according to the recent prices there. Bids, ask prices. So this is on the right side. This is the order book, and this bid ask is information about the best offers for sale and for purchasing. The day range, the 52-week range, and other. This is the range. This is the lowest and the highest price in that period. The volume, the trading volume, it is the total value of the transactions made. Higher the volume, the more popular the stock is. The trading volume changes from day to day. If there are major corporate events, usually we have higher changes in price and higher volume as well. Market capitalization, market cap, see this 1.087 trillion. This would be the multiplication of the market price to the total number of the stocks. Beta coefficient. Beta is the estimation of the firm risk within the portfolio. This is something that worth our attention more in detail, and we will discuss it more in subsequent classes of our course. But so far, let's just remember that this is the estimation of the risk, and the higher it is, the higher would be change of the Tesla price related to the change in the market average. So here we would say on every 1% change in the market, we have 2% change in the Tesla price. Price to earning ratio trailed 12. This TTM stands for trailed 12 months. So for 1 year, earnings for 1 year. This price to earning ratio, and there are multiple other ratios that we might have. Price to sales, or any other relationship between the market price and the accounting information. We use them in order to compare this firm with its peers in the industry and trying to say whether the firm is overvalued or undervalued. If this ratio, and if we would say, if we would compare this price to earning ratio of the Tesla with other automakers, we would say that here we would have, for Tesla, it would be much higher, again, because the market has higher expectation on this share. Earnings per share, we will discuss it again more in detail. This is the estimation of the profitability of the firm. Earning days, it is when the next announcement would be made regarding the quarterly earnings. This is the information on the If the firm would pay dividends, here we would have ex-dividend date is the date at which we have to purchase the stock in order to receive the dividends. And here is some estimation, so some prediction of the stock price. And according to that estimation, currently the stock is overvalued, but frankly speaking, those estimations are frequently wrong. So we cannot say for sure that this is something that would happen in 1 year. And here are former definition of the things we saw on the previous slide: the bid price, the price at which investors are willing to buy shares, and ask price, the price at which they're willing to sell it. In the grade book, they would be bid price left, right price here, and when they match, the transaction is settled. Bid-ask spread, the wider the spread, no, it means the stock is less liquid and there are less chances of making the transactions, and the trading volume is usually lower. So the higher is spread, the lower the trading volume. Market order, and when we want to purchase the stock, there are basic two options, two types of order that we might sell, but when you do it practically, there will be some derivatives out of those two, but those two are primary. The market order is an order to sell the stock or buy the stock immediately at the best price that is available on the market. So if we looking at this picture, if we would send the market order to buy the stock, by the way, at which price we would buy it? If we send the market order to buy the stock, how much we would pay for the stock? Can you tell us?
The lowest price?
No, look at the slide and tell. No, it's number.
$1,099.
Huh?
You said if you want to buy, right?
Yeah, buy. If we want to buy the Tesla stock and we send the market order at the best price available, how much we would pay?
1,102.44. Yeah, 0.44.
Yeah, this is correct. So we would purchase at this price because this is the first price in the order book. This is the cheapest offer for sale. So this is the cheapest alternative for us to purchase the stock. But usually the more wise decision would be to send the limit order. So to predetermine the price and send this order. And all those limit orders, they would be collected in the order book. All those prices are there. Those are the limit orders that other investors send, either to sell the stocks or buy the stocks. And when you do this transaction, it's better not to hurry and stay calm, because otherwise you might lose the money during the transaction itself, because you alternatively you had an option to send the limit order, and in an hour the price might drop and you might have way better transaction. And as we see during the day, stock prices goes up or down, you have a good chances to have a more favorable price than this one. So other things equal, usually the limit order is better. An order book is a collection of all orders which a stock exchange received. The best of them would be presented here, but you might also, if you have some ideas. What would happen? You might send the order at the lower or higher prices. So, and they won't appear here, but all of them are included in the order book.
Excuse
now,
me. Can I have a question about
yeah,
can you please go back to the slides with the Tesla shares? Well, what those like numbers in the middle mean? They're numbers of shares or something. I'm not sure. On the graph, on the right.
In the middle.
Yeah, those.
Here.
Yes.
This is a number of orders. So there are 26 orders to purchase the stock for 1,102.26.
Is it like requests?
Yeah, requests.
Okay.
We call them order. Those are synonyms. In this order is a request to buy or to sell.
Thank you.
The more, and on this chart, the taller the line, the more orders we have for this price. This is cumulative chart. And each step, so if there is a steep step, you see here we have a steeper line because at that moment there were more offers to sell the stocks. And the steeper it is, the more chances to sell it at the higher price. And steepness represents the cumulative number of these orders. Now now we mostly covered the technicality of the trading, but of course this is just an introduction. There are a lot of tools that people use for trading, and this is very interesting topics, and the best way to learn it is to try yourself, combined with theoretical background and some investment philosophy books. But let's stop there for a while and proceed to the estimation of the stock price, because in order to trade them successfully or invest in them, we should have a plan, we should have some understanding how the price is determined. There is, of course, the technical price of the part of the price determination that we just discussed. So when the bid price meets the ask price, this is how it's technically done. But in the long term, and what factors are there behind the market price of the stocks, this is something that we're about to discuss with you. And here, again, everything would be based on the present value concept, on the future, on the cash flows that we expect to receive in the future, and their present value that would represent the market price of the assets, in this case of the stock. We start from the return of the stock, how we would determine it. This is basically the same formula we had for the bond, except for the dividend here and there we had a coupon. The dividend divided on the initial price of the stock would be called the dividend yield. The change in price divided on the initial price of the stock is called the capital gain. And this is the same thing. But the dividends, the longer we keep the stock, the higher would be the cumulative dividend that we receive. So higher would be this part of the equation. But please note that companies do not have to pay dividends. Then we looked at the Tesla. You see there is no ex-dividend date, no information about upcoming dividend. It is because this firm doesn't pay dividend. And everyone is happy because the stock price goes itself, and we have very good return out of capital gain, and there is no need for this firm to pay the dividend. but no, many firms does pay the dividend, so that is why we look at the general formula here. Here is an example. The firm Fledging Electronics selling its stocks for 100 per share today. We expect it to raise till 110 in a year period. And also the firm announced the dividend of $5 per share. What would be expected return? We just use the numbers that we discussed and apply the formula, and here is the result. So expected return is 15%. This is very good return. If the stock provides us such return per year in United States dollars, we are happy with it. Now let's convert the issue and try to understand how we would estimate the stock price itself. And the approach here is that it is a present value of the future cash flows. And cash flows that we would receive can be presented as a combination of the dividend and the price at which we would sell the stock. And as we have a discounting rule, we would divide them on the 1 plus discount rate. So the present value of the cash flows would be this one. So how much we would receive out of this investment? We turn around the formula from the previous exercise, and we see that the result matches. So if we convert this exercise, knowing that the discount rate is 15%, that the dividend is 5%, that the price next year is expected to be 110, we can estimate the current price of the stock. So the price which should be. There is always difference between the price that is actually there and the fair price. But the price, market price, moves to the direction of the fair price. And if we know it, it would help us to benefit from the investment. And in general form, we can present it idea like this, because dividends, they are always different. No, they might, by coincidence, they might be the same, but they do not have to be the same. That is why we would write this formula like that. So the present value of all dividends plus the price at which we would sell it at the end of our investment horizon at this point. And well, this is the same formula that we can convert to this view like we did with the bond, but in the bond we were able to apply the formula of the annuity for the coupons. Here we cannot do this because the dividends are not constant. Those cash flows might be different. And there is a final part. In bonds cases, we called it a par value. Here it is just market price at which we expected price at the end of investment horizon. Here is the same exercise plus one period added to our investment horizon. So here we have two years in our investment, but the process is the same. And here we found the horizon price that makes market value of the present value of the firm equal to the initial one. if we expect the market price to be 121 and in 2 years, and expect to have first year the dividends of 5, second year the dividends of 5.5, the present value would be 100, which is the same as something we had in the previous form of the exercise. But here we should take in mind one important consideration. Maybe you remember from the first lecture we had that one of the assumptions which we have talking about the corporation is the infinite life of the firms. That firms do not have any horizon themselves till which they are going to operate. Once they open, if things go fine, they should function forever. And based on this assumption, we would see that over time, the fraction of dividend, of present value of the dividend in the total price of the stock would increase. This is something we present on this chart. This white part is the present value of the dividend, and what is it, green or green-blue color, it goes down. And resultingly, we can present the formula of the stock price just based on the dividend, because based on these infinity assumptions, and also due to the fact that every time the price of the stock, so regardless of which investment horizon we would choose here, anyway, we can also present this price in the same formula as a present value of dividends that we expect after that. And this allows us to transfer the formula of the stock prices to this view, which is a growing perpetuity formula. It is a present value of the infinite set of cash flows that grow. We cannot say for sure what happens to the firm, but normally firms grow, and basic formula to estimate the stock price would be this one, as a present value of infinite set of growing dividend. This is the formula. The same as investors are mostly interested not in prices as themselves, but on the returns that we might generate from the investment into the stock. This is the formula for the return on the stock. Let's consider the example here. Northwest Natural Gas stock selling at the 49.43 per share. And we have some expectation regarding the dividend next year. Please beware and keep in mind that this perpetuity formula, both growing and ordinary perpetuity, they are based on the assumption that the first cash flow, so first dividend, would be made at the end of the period. By default, we talk about the years. If we talk about the dividend which would be paid now, we would convert this formula, we'll multiply it additionally on 1 plus discount rate. But no, by default, we have such settings that we talk about the yearly period, that the first dividend is paid at the end of the period, and the current, and the price is the current one. And this is the dividend yield return that we expect on this stock. If we, on top of that, if we have some growth assumption, the expected return is going up. You remember that the price of the stock and stock valuation to a large extent comes from the growth expectation, and as a result, having this would substantially increase the return that we expect from our stock. Here are the formulas that we work with. The dividend yield, something that we already discussed. The formula of the stock price for the case of the infinite growth. So this is basic formula here. The return, based on the same assumption, there is G stands for the growth. And something what we should discuss now is where the growth comes from. The growth comes from, there is a, this idea is quite straightforward, but should be understood by you. So if the firm, every period firm earns money on its asset, but in order to grow, the firm has to reinvest money back to the firm. If every time you take out all the earnings that were made, then next period you start from the same value of assets, it means that there is no growth happened. So you start from the same period if you take all the money out of the firm. And the growth comes from the reinvestment of the firm, of the earnings. And in order to estimate what growth would be, we should consider the return on equity, how profitable the activities of the firm are. And return on equity is estimated as earnings per share divided on the book equity per share. And this is a source of growth. So the combination of the earnings of the return on equity plus the plowback ratio. So out of those two values, we estimate the growth rate of the firm. This is something important, and this is the crucial part in the model of the stock price estimation. The payout ratio is a fraction of earnings that the firm would pay out as a dividend, and the plowback ratio is a fraction of earnings retained by the firm, and payout ratio plus plowback ratio will give us the 100%. The firm has basically two options. There are multiple ways firm might return money to the shareholders. They might be paid as a dividend, or there are some other alternative, but all of them, we would call them paying out money. And if the firm reinvests money back to the main operation, we would call it the plowback ratio. And this is how we would estimate the growth rate of the firm. This G that we discussed with you on the previous slide, we multiply the return on equity on the plowback ratio. And this makes a very good sense, as the growth of the total assets of the firm, the growth of the firm as a whole, comes from the its general profitability that is presented as a return on equity, and the fraction of the earnings that firm retains, the fraction of the money that goes back to the business, plus the growth rate of this business. So we can imagine the pile of money which increases by some percent every period. And in order to say how fast this pile of money would grow, we must multiply the rate at which this pile grows and the fraction of money that we leaves back in this pile. So if every period we take all additional earnings out of the pile, every period the pile would be the same. But as we usually take some of this and some of this we leave back, this is how we determine the growth rate of the whole pile of the money, or in other sense, of the entire firm. Yeah, this is the same formula for the situation. Then the growth rate of dividend is not constant. Then in this case we have some estimation of the future dividends and discount them just separately. Then there is a dividend at the horizon value. Till that we have some precise estimation, and after that we anyway would go with some assumption about the growth rate that would be after that moment. Let's consider example. Company Phoenix produces a dividend in 3 consecutive years. First year 0, second year 41 cents, and third year 65 cents. The dividend by the way, sometimes in American books the 0 might be missed. If there is just 0.31, it means 0.31, or this is 31 cents. In the fourth year, the dividend is expected to be 67. After that, we expect the perpetual growth of 4%. 10% is discount rate. What is the price of the stock? Here it is. Yeah, we just have the present value of each dividend payment. Then we have final dividend, using which we would estimate the horizon price of the stock, and then we have to discount it. We discount at the rate of 3. Why? Because here we use a growing perpetuity formula, which itself already includes one step ahead. Yeah, as I told you, the growing perpetuity is a present value of the cash flows when the first cash flow is 1 year later. This is why we additionally discount at the same discount rate as here. Now let's talk about the effect of the reinvestment and the growth, how they are related. For our firm forecast to have a dividend of 8.33 next year, which is 10% or 100% of its earnings. So they plan to pay all money out as a dividend. This would provide investors with a 15% return. Alternatively, we can reinvest 40% of the earnings and invest them back to our business, which will generate us 25% per year. What is the value of the stock under 2 plans? What would be? Let's consider. If we pay all money out as a dividend, we just go with a simple perpetuity formula. So if every period we take all the money out, there is no growth. That is why we would estimate it just with a normal perpetuity. If we plow some money back to the business, we would generate some growth. First, let's estimate the growth rate. in order to do it, as we discussed, we multiply the earnings per share, so the growth rate of the business, on the flowing back, so on the fraction of the money that goes back to the business. And this would be the growth rate of the whole firm. And based on that, we can estimate the stock price. Why we have 5 here? Because 5 is 8.33 multiplied on 0.6. We reinvested 40% back to the business. It means that 60% are paid as a dividend. So this would be 60% out of 8.33. So here we have smaller dividend in the first period than here, but we have 10% growth. And as a result, the total price of the stock is way higher than in this case. And the difference between those two prices is called the present value of the growth opportunity. We can, in order to double check whether this estimation makes sense, we can conduct alternative calculation. Let's do this. So let's, in order to work with these cash flows that we usually work with, let's estimate how much money we would generate on this amount that we reinvested back to the business. So this 3.33 is the 40% of 8.33. This is something that we plowed back to the business, reinvested to the business. And next period, having the return on equity of 25%, we will, on top of this 3.3, we additionally generate 0.25 cents. And this would be, we would additionally generate 25%, would additionally generate $0.83 or 83 cents on this $3.3 that we plowed back to our business. And we can present this decision in the formula of the NPV. We reinvested to the business, or in this case, just let's say invested to the business, this 3.33, which is our investment, so it goes with a negative sign, with the return of, and additionally make 0.83 on this amount. And then we can divide it on the expected return in order to estimate an NPV of this decision. And this decision has a positive NPV. It means that it's worth for us to reinvest money to the business in this fraction of the money. Then we can estimate the present value of growth opportunity using the growing perpetuity formula here. This the same NPV divided on the difference between discount rate and the growth rate that we just received. So this is the present value of additional return that we have after plowing money back to the business, compared with the case that we do not reinvest anything. If we do not reinvest, then NPV would be 0. So we reinvest 0, we make 0, so everything is 0, and here would be 0 as well. But if we reinvest it, we have some additional money, and we can estimate their present value. And here it is, and no, this is the same amount as we had here by comparing the stock price in case of the reinvestment and in case of blowing all money, in case of the taking all money out of the business. And the definition of the present value of the growth opportunity is net present value of the future of the firm's future investment. If we have assumption that the firm would reinvest some money back to the business, then we have the growth, and we can estimate the money that this growth would generate. And also we can estimate this growth itself. So the present value of growth opportunity is usually estimated in monetary units, in dollars, rubles, or wherever. And growth rate is estimated in the percentage rate, and this is plowback ratio multiplied on return on equity, something that we just discussed with you. And the same logic is applicable for any investment project, for any business. As the stock represents the ownership fraction of the firm, some percentage of the firm that we own, this is settled by the stock. It is our right for ownership is approved, so if we have the stock, it means that we own some fraction of the firm. But the same logic that we just used can be applied in order to estimate the value of the entire firm. And this is what we would do if the firm has no stocks publicly traded. This is the same formula. Instead of dividends, we have free cash flows here, but present value of the firm and the horizon value logic remains. Just the types of cash flows are slightly different, but the essence is the same. And here we have a table example. I would encourage you to look at this again yourself when you will work with the materials of the lecture. The logic is the following. We have a near-term estimation of the future cash flows of some business starting from the period 7, from this period. We believe that growth rate will get stable and it would be 6% per year. Before that, at the initial stages, we hope that the growth rate would be higher, for 12% during the first 3 years, 9% during the next 3 years, and then the growth rate. But return on asset is the same. It just asset growth rate would be different. It means that during the first 3 years, we do not take money out of the business at all. And starting from the year 4, we take some of them out of it. How we see that we do not take anything from the business? We start from the value of the asset is 10. We multiply 10 on 0.12 on return on asset, having 1.2, and we reinvest all the money back to the business, having the asset group. So, and there is no free cash flow, so no money is taken out of it. And we end with 11.2, and this is the same value that we would start from. The same for the second year. For the third year is the same, but starting from the year 4, we start to take some money out of it. In order to estimate the earning, we again would multiply the asset value at the beginning on the return on assets. This would be the earnings. But asset growth rate, we would estimate, so this value would estimate by multiplying 14.05 on the asset growth rate, having this amount. And the difference between earnings and the increase in the asset value would be the free cash flow. No, in other words, the difference. So free cash flow plus investment always equals to earnings. The assumptions that we start from are here. We need initial value and we need the return on asset and asset growth rate. The rest is calculated out of this amount. And using this logic, we can estimate the present value of this business. Let's do this. We first estimate the horizon value. Again, we use the same logic. We would go with a growing perpetuity formula. This is, we know that the firm grows for 6 period. Starting from the period 7, the growth is settled, and that is why we would take the free cash flow, this amount, from the period 7 and use it in our growing perpetuity formula. Here, the growth is 0.6, the discount rate is 10, and this is how we would estimate the horizon value of the firm, the present value of the growing perpetuity. As this happens in the period 7, and the one step is already within this formula, we would discount it using the discount factor of the period 6. And this would be the present value of the firm at the horizon value. And also, we should add the present value of the cash flows that firm would generate. Here they are 0.42, 0.46, and 0.5. And starting from that, all subsequent cash flows are already here. Here we have the present value of the future cash flows. And in order to estimate the firm, we just find the sum of those two values. And this is the present value of the business. So something that we covered today, we discussed how to estimate the stock prices, we discussed how they are traded, and we discussed how to apply this logic to the value in the business. Something that I want to briefly introduce with you now and to demonstrate to you at this moment, and we will publish it officially tomorrow. Here it is. This is the homework. We will use Smart LMS. So our platform that we work with is Smart, not LMS, but let's change it direct. Smart LMS system, where we would ask you to upload my Excel spreadsheets with the answers to the assignments that we offer to you. The assignments would be to estimate the risk and return of the stock portfolio. So far, not everything is clear to you how to do it, because we will discuss it in several classes until the end of this module. But you will have enough time to prepare for this. What you will need to do, you will need to download the stock price for 5 stocks and conduct some calculations with them. Everyone would have different stocks. The spreadsheets with the stocks that you that are assigned to you will also inform you on that. And the source of data that we recommend for downloading is Yahoo Finance, and the time interval that we work with would be ending in November 13th. These prices would be available to you starting tomorrow, because the closed price at today's would be published tomorrow. That is why we would publish this assignment tomorrow. It would be in the LMS as an assignment, so you will see the notification on that. So you would download the data from Yahoo Finance, conduct some calculations within with this data, and upload the materials to the platform. If you would have a question, you might ask me or Vladislav on that. Yes, and when you will download the data on the stocks, there are multiple prices available to you. There is close price and there is adjusted close price. The difference between those two is that adjusted close price include information on the stock splits and the dividend, and adjusted price, close price, is a better representation of the total earnings that we have on our investment in the stocks, because it includes dividend and the splits of the stocks. So then multiple stocks were merged together or vice versa separated, and that is why out of those two prices we recommend you to work with the adjusted close price, because using that you have more adequate representation of the returns that generated by your stocks. This is it so far. We shouldn't discuss these assignments in detail regarding the things you have to do here, because not everything is clear to you so far. But all of those terms will be discussed on the lectures and on the seminar, so there won't be any new concept here. Just you should apply them to the real numbers derived from the stock exchange. This is it. If you want, you can ask the questions on the materials we had today on the lecture. Also, you can ask questions on the organizing of the homework. Yes, I see the question. Please go ahead, Amirar.
Yes. Yeah, so I have two questions. First of all, in Excel, there are two ways to calculate certain things. For example, for NPV, we have the NPV function in Excel, but we can also use formulas to calculate it. So which one is allowed for this homework project?
Both of them are allowed if you apply them correctly. In this, when we collect this information, for us, it's important to see the formulas. If there are some automatic tools, like data table or something, that leaves no traces there, we ask you not to do this, because then we are not sure who really did this assignment and the logic how you found this estimation. But when you talk about NPV, you can use both NPV function or can do it so-called manually, just with other functions in these spreadsheets.
Great. And the due date for this homework is not anytime close, is it? Or should we start now? No.
The due date would be, we should think about it. We will, so you will have enough time. It is somewhere at the end of the December. Maybe not the end, but last third of the December. Say something like that. Okay. Actually, to do this assignment, technically, if you know what to do, it would take 2 hours, maybe 3. So it's not that time consuming. Just as you do it probably first time, it might require some time, but generally, if you attend the lectures and the seminars, it won't be too time consuming, so you will have enough time for this assignment.
Great, thank you.
You're welcome. Anything else?
Thanks.
Yes, I see Anastasia raised the hand.
Yeah, I have a question about the homework as well. Will there be like template how to like about the format, how we should do it, or maybe an example, or are we free to do like the format as we want?
Yes, Anastasia, I see a question. No, we will not offer you the template because there is multiple ways you can present it. And also the part of this assignment is for you to practice presenting information clearly. So we will not provide you any templates, just do according to your logic. Make sure that it is understandable for external observer.
Okay, thank you.
Yeah, you're welcome. Anything else? One thing I should mention here, that we will strictly punish you for the plagiarism here. This is individual assignment, and if we see that it is not you who did it, or there are multiple tools that we use to see it, and usually it is visible, no, you will be punished for that. At least you will have 0 for it. Maybe depending on the severity of cheating, maybe we will also do some other formal procedure. Yeah, but no, of course, you can discuss it with each other, consult, like we cannot control your private communication, but it is individual assignment. You cannot take the template of your friend and fill in your numbers in it. Everything of that kind is considered as a cheating, because the template is also something that you should present. And please, let's stay ethical. Please do it yourself. Anything else? No? Okay, good. Thank you for being here today. Take care.
Thank you. Goodbye.
Goodbye.
Thank you. Goodbye.
Bye.
Bye.
Goodbye.
Thank you.